Short-term finance is essential for supporting the day-to-day operations of a business. Organizations require working capital to purchase inventory, pay employees, meet operating expenses, and manage fluctuations in cash flow. Short-term financing sources are generally repayable within 1 year and are designed to address temporary funding needs rather than long-term investment requirements. Businesses can obtain short-term finance from a variety of sources, including trade terms offered by suppliers, financing arrangements with trade partners, and facilities provided by banks. Each source has distinct characteristics, benefits, costs, and risks that influence how organizations manage liquidity and working capital effectively. Trade terms represent one of the most common forms of short-term finance available to businesses. Trade terms refer to the conditions under which suppliers allow customers to purchase goods or services on credit. Rather than requiring immediate payment, suppliers provide a credit period during which payment can be deferred. Typical trade terms may specify payment within 30, 60, or 90 days after delivery. By delaying cash outflows, businesses can sell inventory, generate revenue, and collect receivables before settling supplier obligations. This source of finance arises naturally through commercial transactions and is therefore often described as spontaneous financing. The financing benefits associated with trade terms depend largely on the relationship between the buyer and supplier. Favorable trade terms can significantly improve working capital management by reducing immediate cash requirements. Some suppliers may also offer discounts for early payment, allowing businesses to choose between conserving cash and reducing purchasing costs. However, extending payment beyond agreed terms can damage supplier relationships and potentially result in penalties, reduced credit availability, or interruptions in supply. Effective management of trade terms therefore requires balancing liquidity needs with maintaining strong commercial relationships and preserving access to future supplier credit. Trade partners can also provide short-term financing through various commercial arrangements. Trade partners include suppliers, distributors, customers, and other organizations involved in the business value chain. Financing support may take the form of extended credit periods, advance payments from customers, supplier financing arrangements, or cooperative funding agreements. Strong relationships with trade partners can improve access to flexible financing and reduce dependence on external lenders. In many industries, long-term commercial relationships enable businesses to negotiate favorable payment terms that support operational efficiency and cash flow management. Consequently, trade partner financing often represents a valuable strategic resource. Banks constitute another major source of short-term finance and provide a range of funding solutions tailored to working capital needs. Common banking facilities include overdrafts, short-term loans, revolving credit facilities, and lines of credit. Unlike trade-based financing, bank finance is obtained through formal lending arrangements and typically involves credit assessments, interest charges, and contractual obligations. Banks provide businesses with immediate access to funds, allowing them to address temporary liquidity shortages, finance seasonal fluctuations, or support growth opportunities. The availability and cost of bank financing depend on factors such as creditworthiness, financial performance, and collateral availability. One of the principal advantages of bank financing is flexibility and scalability. Businesses can often access larger amounts of funding than those available through supplier credit alone, making banks an important source of working capital support. However, bank financing usually carries explicit costs in the form of interest and fees. In addition, lending agreements may contain covenants and reporting requirements that restrict financial flexibility. Organizations must therefore carefully assess borrowing costs and repayment capacity before relying heavily on bank finance. Effective management of banking relationships can improve funding access and strengthen financial stability. In summary, trade terms, trade partners, and banks represent important sources of short-term finance that help organizations manage liquidity and support daily operations. Trade terms provide supplier credit through deferred payment arrangements, while trade partners may offer additional financing support through cooperative commercial relationships. Banks supply formal financing facilities such as overdrafts and short-term loans, offering greater funding capacity but usually at a direct cost. Each source has unique advantages and limitations relating to flexibility, cost, accessibility, and risk. Understanding these characteristics enables management accountants to select appropriate financing solutions, optimize working capital management, and maintain financial resilience.